The purpose of this presentation is to go behind the curtains of CVS and Walgreens, understand their current financial standing, and consider changing capital structure to maximize their value. There are high hopes the next time you pass by CVS or Walgreens that you will look at them from an investor's perspective versus simply just an ordinary customer. Who are the owners? Shareholders consist of individual people, mutual funds, and institutions that have purchased stock in a particular company. These shareholders buy stocks because they expect a good return on their investment. Directors are hired by shareholders who make fundamental decisions and hire a management team to deal with everyday operation activities. Notice that 86% of CBS is held by institution and mutual fund owners. 63% of Walgreens is held by institutional and mutual fund owners, and 8% is held by all insider and 5% owners. Institutional owners. CBS and Walgreens share 70% of their top 10 institutional owners. For instance, FMR, Vanguard Group, State Street Corporation, Wellington Management Company, Black Rock Institutional Trust Company, Franklin Resources, and JP Morgan Chase Company. Mutual fund owners. Notice that CVS and Walgreens share 50% of their top 10 mutual fund owners. For instance, Vanguard Total Stock Market Index Fund, SPDR S&P 500 ETFs Trust, Vanguard 500 Index Fund, Vanguard Institutional Index Fund, and Vanguard Wellington Fund Inc.
Investors do care about the cost of a company's capital because the cost of capital ultimately affects the value of the company. A company's capital is made up of debt and equity. Finding the right mix or ratio of debt and equity will maximize the company's value. There are advantages for a company to have debt or leveraging its equity. Tax deductions on the interest paid to debt is a primary advantage to carrying debt. So the higher a company's tax rate, the greater the benefit. However, taking on too much debt is bad too. Too much debt increases the likelihood a company will go bankrupt. A higher probability of bankruptcy places risk on investing in a company and will scare potential investors away. Too much debt also adversely affects a company's bond rating, raising the overall cost of capital to a company. The following are factors for a company to consider when looking for their optimal debt ratio. 1. The tax rate. As mentioned above, when a company has a higher tax rate, the tax savings are also greater with more debt. However, if a company's debt ratio gets too large, it also tends to increase the cost of debt for a company. Therefore, balance is needed. CVS has a slightly higher tax rate at 38.2% compared to Walgreens' tax rate of 37.1%. So it may be slightly more advantageous for CVS to take on more debt considering only tax savings. Second, the interest coverage ratio, or the ability to make interest payments. If a company's gross earnings are large, it is a good sign that the company can make their interest payments too, as shown by a large interest coverage ratio. Walgreens' interest coverage ratio is 24.6, while CVS interest coverage ratio is 12.2. This shows that Walgreens has a much higher ability to cover its interest charges than CVS. Default spreads on corporate bonds. If a company issues corporate bonds and gets into financial troubles, it may lose its ability to make the required interest and principal payments. CVS and Walgreens have respective credit ratings of BBB+ and BBB. This suggests that each company will pay approximately the same interest rate on their corporate bonds. And finally, the firm or capital projects. Both CVS and Walgreens are expanding, and therefore it is in their best interest to have a low debt ratio to give them the most flexibility in the future for borrowing for capital projects.
Cost of debt financing is the price a company must pay to a lender in order to obtain funding for the overall company or specific projects. The cost of debt financing is composed of two different variables. The first one is the risk-free rate, which normally is a 10-year Treasury note. In this case, it's 2.75%. The second variable is dependent on the credit rating. Both CVS and Walgreens have a similar credit rating of BBB, which generates a spread of 2%. This results in a pre-tax cost of debt of 4.75%. Next, you consider the tax rate of CBS, 38.61%. The interest is deducted from taxes and generates an after-tax cost of debt 2.92%. Walgreens has a smaller tax rate, which means that it's going to get a less tax deduction, and their after-tax cost of debt is 2.99%. What is cost of equity financing? Cost of equity financing is a theoretical return on investment that a shareholder needs to witness in order to compensate for the risk that is being taken on a particular company. Cost of equity has three different elements. The equation is equal to risk-free rate plus market risk premium times stock risk beta. Recall that the risk-free rate is 2.75%. The market risk premium in year 2013 was 5.7%. Notice that beta for CBS is 0.8452, which generates a required rate of return of 7.57%. Walgreens has a riskier beta of 1.132%. This correlates to a required rate of return of 9.19%.
The cost of capital is a mix of company debt and equity costs. Because it is most often a combination of both, we use a weighted average cost of capital approach, or WACC. The cost of capital can be thought of as a hurdle rate for a company to get over before it can generate positive value. Therefore, the cost of capital should be carefully looked at by CVS and Walgreens when considering whether a company should proceed with new capital projects. We see that CVS has a slightly lower WACC compared to Walgreens. This makes sense because Walgreens has a more expensive debt and equity cost.
Changing the capital structure to lower cost of capital. The WACC value can be reduced by both CBS and Walgreens through a simple capital restructure. CBS could have a WACC savings of 0.30% by increasing their debt structure of 27.59% to 50%. Walgreens seems to be more currently optimally structured than CBS because the smaller WACC savings of 0.05%. Walgreens only had to increase their debt structure from 34.06% to 40%.
The results of the financial analysis show that both companies need to increase their debt ratio to optimize the value of their companies. Walgreens currently has a debt ratio of 34%, while the analysis shows its optimal debt ratio is at 40%, a difference of approximately 6%. The analysis suggests making this change would lower its WACC, or weighted average cost of capital, from 6.86% to 6.81%, increasing the perpetual growth value of the company from $85.5 billion to $86.6 billion, an increase in value of 1.3%. CVS, on the other hand, currently has a debt ratio of 27.6%, while the analysis shows its optimal debt ratio is at 50%, a difference of approximately 22%. The analysis suggests making this change would lower its WACC from 6.06% to 5.77%, increasing the perpetual growth value of the company from $110.1 billion to $117.1 billion, an increase in value of 6.4%. While the analysis shows a higher debt ratio as optimal for both companies, each company needs to carefully consider what too much debt leverage can do in the long run if not carefully monitored.
Would more debt create unnecessary risk? Natural habits may cause the normal financial student to conclude that a capital restructure to minimize WACC and maximize company value is an easy decision. Why don't these multi-billion-dollar corporations simply increase their debt to maximize their worth? Should their CFOs be fired? The table below shows the estimated current and optimal locations of CVS and Walgreens with respect to capital debt ratio. There seems to be a drastic change in cost of debt and the next level of debt ratio falling into the C credit rating. There is no transition between the optimal bond rating A3 and the next rating C2. The pre-tax cost debt will spike from 4.05% to 11.5% if Walgreens and CVS were to surpass the optimal debt by 10%. The reason for this drastic change is due to the interest coverage ratio, which controls the bond rating, hence the bond interest rate. The other table clearly shows that the B synthetic ratings lay between interest cover ratios of 1.25 and 2.99. This seems like a thin line that should be respected because of the expensive debt if crossed. If CVS and Walgreens are at suggested optimal debt capital ratio and EBIT suffers an unpredictable hiccup or the rating interest cover ratios change negatively, then these two companies will be bumped into very expensive debt. The S&P currently rates CVS and Walgreens with the B rating section, which may be an indicator that these companies are already running at optimal debt levels. Realistically, they should not toy with increasing their debt capital.
Rite Aid is the other large retail pharmacy chain in the United States, but it's only a tenth of the size of Walgreens. Walgreens has double the assets in cash compared to the other companies. It is also interesting to note that Rite Aid has much less, almost half as much, long-term assets compared to Walgreens and CVS. Looking at liabilities and equity, both Walgreens and CVS have similar compositions. However, Rite Aid is dramatically different, most notably in the negative shareholder equity and very large percentage of long-term liabilities. This may suggest massive expansion funded by long-term debt instruments or large marketing efforts sometimes seen by newer companies. After considering the aforementioned financial analysis of both Walgreens and CVS, we see that both companies may be undervalued. Both companies can increase their overall value by increasing their debt ratios. CVS had a closing price of $66.96, while our analysis shows that it could be at $72.86, which is an 8.8% increase. Walgreens, on the other hand, had a closing stock price of $59.54, and the analysis shows it could be at $60.76, which is a 2% increase.